Look, if you're starting entirely from scratch in 2026, we're going to break down exactly how the source material suggests building a beginner portfolio with 500 pounds a month. And I promise you, zero jargon required. Investing can honestly feel like this intimidating maze of complex terminology and endless, confusing choices, but it genuinely doesn't have to be. Today, we're stripping all of that away. I'm going to walk you through the exact blueprint outlined in the research for a complete beginner. No guesswork, no overly complicated trading strategies, just a highly effective, repeatable system designed to put your money to work. Right off the bat, here's the complete blueprint up front. There's no mystery here. This is exactly where every single pound of that 500 pounds is going to go. We're splitting the monthly investment across 3 specific vehicles: a workplace pension, a lifetime ISA, and a stocks and shares ISA. Each of these 3 slices serves a very specific, highly optimized purpose in growing your wealth. We're going to break down exactly why this particular split is the ultimate starting point for a UK investor in 2026, based purely on the data. Okay, here is a quick look at our step-by-step priority cascade. We've got quick context, step 1 covering free money first, step 2 for the Lisa bonus, and step 3 for long-term growth. Let's get into it. Starting with section 1, quick context, and the prerequisites for your 500 pounds. Before a single pound is actually deployed into the markets, we need to establish exactly who this monthly plan is for. This explainer assumes a few foundational things are already in place for you. First, you've already got your emergency fund sorted, meaning you've got a cash buffer sitting there for life's unexpected surprises. Second, you've completely paid off any high-interest debt, like credit cards, because let's be real, the interest on those will always eat into your investing gains. And finally, this strategy is for you if you want a low-effort, highly effective system without spending hours every single week researching individual stocks. This isn't for day traders. It's for people who want a set-and-forget wealth-building habit. Moving right along to step 1, free money first, using the workplace pension. 100%. Seriously, if you're employed in the UK, checking your employer's pension matching scheme is your absolute #1 priority. Why? Because if your employer matches your pension contributions up to, say, 5% of your salary, that is an instant 100% return on your money. You put in a pound, they put in a pound. Boom. It is actually astonishing that UK workers leave billions of pounds of this literal free money on the table every single year, just by opting out or not maximizing their match. It's the single most powerful tool in a beginner's arsenal, and nowhere else in the investing world are you going to find a guaranteed 100% return on day 1. Now, just a quick aside for the entrepreneurs and freelancers tuning in. If you're self-employed and you don't get an employer match, you are not left out in the cold. You'll want to briefly look into a SIPP, that's a self-invested personal pension, as your alternative. While you won't get that employer match, a SIPP still allows you to claim massive tax advantages from the government, effectively boosting your contributions before they even hit the market. It's a fantastic alternative to make sure you're still building that essential retirement foundation. All right, on to step 2, the Lisa bonus, specifically the lifetime ISA if you're under 40. The lifetime ISA, or Lisa, is just incredibly powerful. A $250 monthly contribution triggers a massive 25% automatic government bonus, added instantly on top of your own cash. That means for every $250 you put in, the government literally just hands you $62.50. Absolutely free. That turns your $250 into $312.50 every single month. It's incredibly rare to find a guaranteed 25% boost on your savings, which is exactly why this is our crucial second step. So why exactly 250 pounds a month? Well, it all comes down to this number, 4,000. That 250 pounds a month translates to 3,000 pounds a year, which means it perfectly keeps you within the annual 4,000 pounds Lisa cap without ever going over and risking any annoying penalties. It's a comfortable, steady amount that maximizes your monthly bonus while still leaving enough room in your overall 500-pound budget for our final growth step. You do have to remember, though, that a Lisa comes with a couple of specific conditions. You've got to use it for either buying your first house deposit or funding your retirement. Specifically, you can access it penalty-free after age 60. You just need to pick the one that fits your beginner goals. If you're aiming to get on the property ladder, this is your absolute ultimate deposit-building tool. But if you already own a home, it instantly transforms into an incredibly tax-efficient secondary retirement pot to run alongside your pension. And that brings us to step 3, long-term growth, utilizing the stocks and shares ISA. With our free money fully secured from both the employer and the government, this is where your money really starts to stretch its legs over the decades. We're taking that remaining 250 pounds of our budget and putting it into a stocks and shares ISA to act as your core long-term growth engine. And we're keeping it incredibly straightforward. You do not need to pick individual stocks to be a successful investor. In fact, for a beginner, a simple global index fund or tracker is the perfect low-effort starting point. By buying a single global index fund, you're basically buying a tiny slice of thousands of the biggest companies in the world all at once. It gives you instant global diversification, drastically lowering your risk while capturing the overall upward trend of the global economy. And this whole setup is a perfect example of pound cost averaging. By investing exactly £250 every single month into your index fund, regardless of what the crazy news headlines say, you naturally smooth out the market's bumps and drops. Think about it. When the market is high, your £250 buys fewer shares. But when the market dips and things are cheaper, your £250 automatically buys way more shares on sale. It entirely removes the stress of trying to time the market, which, let's be honest, is a game even the Wall Street professionals usually lose. Let's bring all these numbers together and look at the total architecture of this strategy side by side. First, we secure the workplace pension match for that instant 100% return. Then, we direct £250 to the lifetime ISA to lock in the 25% government bonus for either a house deposit or retirement. Finally, the remaining £250 goes straight into the stocks and shares ISA invested in a global index fund for diversified, long-term growth. It's clean, it's balanced, and it covers all your financial bases without any complicated guesswork whatsoever. When you project this £500 a month out over, say, a 10 to 20-year timeline using realistic average growth assumptions, the snowball effect is just wild to witness. In year one, you're simply building the habit. It might feel a bit slow, but you are laying the critical foundation. By year 10, your money has begun generating its own returns, and compound interest is accelerating your portfolio's growth significantly. By year 20, that consistent £500 a month, supercharged by those employer matches and government bonuses, transforms into substantial, genuinely life-changing long-term wealth. Now, quick time out here. I do have to remind you that this projection is an illustration, right? It's not a guarantee. The stock market is never a straight line up. It's entirely natural for markets to go up and down over the short term. The key to capturing that 20-year growth is weathering the temporary dips without panicking. History shows us that over long stretches of time, the global market trends upwards, but you've got to stay strapped in for the ride. Which brings us to a really critical realization. So what's the absolute biggest beginner mistake in all of this? Well, it's not picking the slightly wrong index fund or using the wrong app. The biggest mistake is sitting in cash completely paralyzed, waiting for the perfect time to start. Let me tell you a secret. The perfect time simply doesn't exist. If you wait for the news to be entirely positive before investing, you're going to be waiting on the sidelines forever, and you'll miss out on years of vital compounding growth. Look, stopping your contributions after one bad month in the markets is a tragic reality for a lot of people, and it will absolutely kill your wealth-building momentum and lock in your losses. The true path to success is staying consistent over the decades. When you're investing monthly using our strategy, consistency matters so much more than timing the market. Remember pound cost averaging? Those bad months are actually when your monthly $500 is working its absolute hardest for you by scooping up shares at a major discount. If you found this structured approach helpful, the source material also applies these exact same foundational principles to larger amounts of capital. It shows exactly how to effectively manage lump sums of £10,000 or more using this same repeatable system. You'll definitely want to check out that £10,000 investing explainer next, and make sure to subscribe to the explainer for more deep dive source breakdowns just like this one. Before we completely wrap up this explainer, I want to leave you with one final question to answer in the comments below. How much are you actually investing monthly right now? Whether it's £50, £500, or maybe you're just getting ready to make your very first deposit today, I would absolutely love to hear where you are on your wealth building journey. Taking action is the most important step. Thanks so much for joining me on this explainer, and I will see you in the next one.